Hello and welcome to a brand new show of Market Makers, and we are at that juncture where everyone perhaps is asking a simple question. Is the worst behind us? And is the worst behind us? Logically, if you connect the dots now, what bothered the market in the month of Jan, I'm talking about local markets, the sell-off in Adani group of stocks. The turning point, the talking point for Feb and March was US regional crisis, and today we are talking about monsoon and return of inflation, given that we are in for a challenging summer. So is the worst really behind us? And if the worst is behind us, how can one really participate in this bull market which had hit a pause button in last couple of months? Now, for long-term investors like Milind Karmarkar, well, these markets, when they consolidate, they gave a great opportunity. And where is the opportunity in this market? Let's discuss all that and much more with Mr. Karmarkar. Fantastic to have you back. Thank you for joining us. I'm meeting you in person actually after COVID.
Almost 3.5 years.
Yeah, it's so nice to connect with you and have you back in our office. We've hit a pause button.
Yeah.
Is this the calm before the storm, or a pause which in a sense in hindsight would be considered as a great buying time?
So my personal view is that it's a great buying opportunity because I always believe that human brain is wired for the short term. I try and connect history with the current situation. It's nothing to do with whether history repeats itself. I think history repeats itself because it's all about human behavior. So the way humans behaved when there were a similar situation, and I think the behavior will continue to be the same. So that is the reason why I believe that we were, most of the situations which we came across between 98, 99 to 2003, we have seen a repeat of almost all those situations in the recent past.
Give me an example of what you're referring to.
Okay. So 98, 99, we had the banking crisis, NPAs went up to 10%. Then government had to restructure the banks. They had to put in a lot of money into the banks. We had one of the worst periods between 93 to 2003 when virtually market had not given any returns. Most of the infrastructure stocks had come out with bad results. And we had in 2001, we had 9/11. Prior to that, we had SARS. Because of that, there was, of course, it was not as bad as what we had seen recently. But still, it was pretty bad, especially in Asia and Southeast Asia. Then we had Iraq war. So there were a series of events which had impacted the markets between, say, 2000 to 2003. We had seen a similar situation now. We had bad NPAs in the banks, which now have corrected, and now we are at 1.5%, 2%. We also had, recently we had COVID, which impacted. We have a Ukraine war as of now. So I remember reading a communique from Reserve Bank of India in 31st March 2003.
Not 23, 2003.
2000, okay. That's correct. That's correct. 20 years back.
Okay.
So, which went on saying that though India is the fastest growing economy as of now in India, in the world, we still have worries about the global growth. It is likely that most of the global growth will fall below 2%. In fact, some of the countries may go into recession as well. We don't know how the impact of Iraq war will be, and it could hit India's future as well. And because of all of these things, we are extremely cautious. And then RBI had also increased interest rates at that point in time. But things changed, and then you know how the markets and the economy behaved between 2003 to 2008. Like, we had a GDP growth of, I think, 3.8% in 2003. We went up all the way to 8.5%. So that is, even oil prices went up during that time. So we are seeing a repeat of that as well.
Okay. So let's assume that the setting on the table is pretty much the same.
Correct.
Which is, we are in a depressed global growth environment.
Right.
And commodity prices could go higher as growth comes back.
Yeah.
So while the setting on the table is same, I would say that the cuisine is also different.
Sorry?
The cuisine on the table is also different, right? Which is that you had China, which started leveraging and started the insatiable appetite to consume from China came between 2003 and 2008. That will not happen again. The central bank's balance sheet were at a much different level in terms of their debt levels and ability to spend.
Yeah.
Now they have to contract the balance sheet. And third, and the most important aspect, is the starting point of valuations. So the setup may look like the same, but the underlying circumstances are also different.
Okay, let me come to valuations first. So most of the infrastructure companies were showing losses that time. So their valuations were infinite, frankly. So that is as far as the infrastructure companies are concerned. As far as commodity companies were concerned, so commodity, I think we have seen the first wave of the boom already there. Okay. So there are certain things which can change 2-3 years here and there. Same thing happened with hotels also. I mean, hotels, if you see, if they are in losses, the P's can be infinite. And that is what we have seen till a couple of years back. But I remember Indian hotels going up 10 times that time as it came into profits. Yes,
so between
it did.
2003 and 2008, Indian
2003
hotels
to 2006, it
Indian
came
hotels
down
was up
again.
10 times.
Yeah. So I think it's very similar. So yes, I agree that in certain cases valuations may be high. Like that point in time, take for example, retail was not the flavor of the season that point in time. But the growth had just started. They had just entered businesses. I mean, whether it was Trent, whether it was Future Retail, most of them had just come into the market. Even Bata was at that point in time not doing so great as it was doing a few years back. Now, of course, there has been an impact. But, and of course, the per capita income, that was significantly low. So yes, the cuisine is different, but the appetite still remains same. In fact, the appetite probably is higher. And because of that, I do see a repeat of 2003 to 2008 that could happen in the markets. And yeah, as far as China is concerned, I think India can replace China. What happened between 2003 to 2008 in China, maybe India will drive it this time.
So if the markets have to go the 2003 and 2008 way,
Yeah.
that time it was not TMT, but it was old economy.
Yeah.
It was power. It
Yes.
was infrastructure.
Yes.
Asset owners actually outperformed.
Yeah.
Are we in for that trade again? Because that trace is visible. NTPC, Coal India, these asset owners are coming back.
True, true.
L&T hit a new high yesterday.
Yes, it did. So industrials are likely to do very well. And there is one more similarity. When at that point in time, government spent again a lot on infrastructure. But at that point in time, it was power infrastructure. This time, they are spending on power as well as railways. So there is a possibility that industrials can do very well going forward. But again, what I have seen in the markets is that the leaders of the previous rally normally don't lead. So last time we had seen companies like Voltas going up 40-50 times, Larsen going up 25 times, ABB going up about 40 times, Crompton Greaves going up 100 times, Thermax going up 60 times. So that may not happen. That may not happen.
So what will go 40-50 times in this rally, in this leadership?
So
frankly,
I have not been able to identify something which will go 40-50 times. But I think anything to do with consumption. And the reason I'll tell you, I do believe that overall the per capita income can move from $2,500 to roughly about $5,000-6,000. And if that happens, the boom in consumption can be phenomenal. So I would still continue to identify companies in consumption which can do very well going forward. So I'm not saying that like last time market may go up 6-7 times. We have already we have doubled ourselves. So maybe a double again from here, possibility. But within that, which will go up 5-6 times as of now, I think if one wants to take a bet, it would be in consumption.
Most of the consumption stocks are trading at P multiples which are north of 50.
Absolutely.
That's the benchmark.
Absolutely.
History, since we are examining history here, historically when P multiples have gone to north of 50, the future returns are always compromised.
Right.
So why do you think history this time will not play for consumer stocks?
Okay. I'll give you an example in apparel. I think overall apparel market in India is about 7 lakh crores. And there is a 8-9% growth in the apparel market year on year. So that means about a 60,000 crore rupees growth is there in the market. If you add the sales of all the organized retail, it still doesn't add up to 60,000. So that is the opportunity. So if the opportunity is large, these companies can grow at 35-40% year on year for next 10-15 years also. And that is the reason why the P multiples may not contract, but at the same time, those 50, 60 times seems to be difficult.
So for the organized apparel market, and there are a handful of players here, do you see them growing individually at 20% for next 3 to 5 years?
Yes, definitely.
Which means if you are looking at buying some of these listed apparel stocks now, and we'll talk about the themes apart from apparel, if you're buying them even at these P multiples of 50 plus, if the earnings growth is 15 to 20%, they can still give you a stock market return of 15 to 20% in 3 to 5 years.
Definitely. Because the P's will continue to be high.
But if you're looking at a market which could be as vibrant as what we've seen between 2003 and 2008,
yes,
then isn't it time to identify real big multi-baggers? Because 20%, 30%, some would say, may not be the best return in this kind of scenario.
That's the whole game, right? To identify multi-baggers and to hold on to it during this boom. So we are still trying to do it, and I keep my fingers crossed saying that I should be able to identify at least one or two, because that's more than sufficient. So we're still trying, but it would be in consumption game. That is definite. The space will be consumption.
A thought which I'm getting from a lot of original thinkers is that for those who bought into Nestle and let's say a Colgate or a Lakme, now Trent, that if you're buying into some of the consumer tech stocks now from the listed internet space, essentially you're buying some of the consumer stocks in 1990s and 2000. Let's say it's Zomato or Paytm is not consumer tech, but let's say Policy Bazaar. Would you buy into that argument?
So we are examining those, because take for example, so I have to sort of balance between buying an insurance company and buying an insurance broker. Okay. So in that case, a tech company like Policy Bazaar could be interesting. Let me clarify, we have neither bought anything, neither have we sold Policy Bazaar. So we are examining these type of companies, because yes, they can be interesting. So we are looking at tech as well, because as I said, anything to do with consumption. So whether it's a pharma company, whether it's a pharma distributor, whether it's a company like insurance brokers, or even a food delivery. So, but there has to be a cash flow which is not in so distant future, because if cash flow positivity is not there, then I wouldn't like to touch the company.
But Mr. Karmarkar, when you bought into Voltas, that time it was a loss-making company.
Absolutely.
There was no P multiple.
Yes.
So when you were investing with an upside, you were betting on the business cycle to turn.
That's
so some of the consumer companies or the fintech companies may not have cash flows today. But if I look at the commentary, let's say from a Zomato or a Policy Bazaar, now you're in Paytm, they're giving you a complete path to profitability. So what looks horrible like a hole may actually be a path which will be very different as things progress.
No, I agree to you. So in these type of cases, it's very important to go through notes on accounts, to go through the balance sheet line by line and see whether they will actually be making money. Because many a times there is a lot of things which are hidden in the balance sheet. So one needs to study that. And yes, if you are confident that, I'm not saying that in the next quarter, but even if they start making positive cash flows in 1 year, 1.5 years, I will still be a bet for that.
For this decade, what to your mind could be a compounding machine? More like a linear trend. The stock may not do well this year, it may not do well next year, who knows, market conditions in the short term
I agree.
Are a function of sentiment. But you're confident that this business or this company will continue to add earnings? Because ultimately when earnings they come out, markets will recognize it.
Absolutely.
Where are you confident of this linear trend in earnings, apart from consumption?
You're putting me in a... Anyway, so I think industrial should do well, because...
Define industrials for us.
So, okay, industrials is anything to do in power ancillaries, in industrials is anything to do in railways, so things like that. So they should do well, because government is spending a lot. The capex cycle has just started, and in both cases, whether it's railways or whether it's power, the requirement can be huge for a country like India going forward, and that is the reason why that space could be interesting.
The big difference, Mr. Karmarkar, at least I can see between 2003 and 2023, we're talking 20 years here, just a rhyming word, 2003 and 2023.
I know.
Is the government is now decisively spending in the digital space. The
Yes.
stacks are getting created.
Correct.
The Aadhaar stack, the UPI stack.
Yeah.
That's where the government focus and the uniqueness is there. The India advantage is there. How can an equity investor participate in this entire government spending in the digital space?
So digital space, I think the biggest beneficiaries of the digital space could be fintechs.
Okay.
Though as of now, there is no fintech which is making actually money. I mean, they are not even, forget about being cash flow positive, they are not making money. But that is one space which can be interesting going forward. So we are keeping an eye on that space as well. And wherever we find an opportunity and we find that the company is close to generating positive cash flows, we could go and look at these companies in detail.
You mentioned Indian hotels, and
Yes.
again, you're feeling the vibe and looking at the last quarter numbers. Indian hotels is going through a boom.
Yeah.
The management is confident that the boom is real.
Yes.
And the boom is here to stay. So for next couple of years, can a stock like Indian hotels be a direct play on consumption?
It can be. So if I look at Indian hotels or most of the hotel companies, they are already up 5 times. So they are up from 60, 70 rupees to 300, 320 rupees. So whether a repeat of that will happen, I don't know. But even now at these prices, they should be able to do well for the next couple of years at least.
Let's go back to your favorite stock, Trent. It's holding on, sir. It's holding on at a time when high P stocks are actually getting smashed.
Yes.
Nestle started underperforming. You look at Asian Paints, it's gone into time-wise and price-wise correction. I can say the same for HUL.
Yeah.
But why is Trent outperforming? It's an expensive stock, yet it's outperforming.
Okay, so I think Trent spent a lot of time in getting their business model right. And once their business model was right, now what they are focusing on is increasing density. So like if you had five west sides across, say across Bombay, now you will have 8 or 10 west sides. But besides that, their other model, which is Zudio, has been doing very well. And the look and feel is also excellent. The price points are good. And that is the reason why Zudio is growing faster than Trent. So that is the reason why I think people are willing to bet on a company like Trent, where though the P's are extremely high, and in normal circumstances, one would not have looked at such companies, but the growth pathway is also phenomenally long. And that is the reason why probably people are looking at this company.
You've been an early investor in Trent.
Yes.
So you have a huge comfort and a strong margin of safety.
Yes.
But for someone who is really watching the show and wants to really understand and implement,
Yeah.
is there margin of safety in a stock like Trent now also?
So it's like this, Dikunj, that while buying any stock, you need to have comfort with the business model. So as you said that I have been looking at Trent for almost 20 years. And I believe that I understand the business model. I really don't know, but that's what I believe. And that is the reason, that is the reason why my confidence comes from.
Did you buy DMart?
So DMart is also interesting because I think that whether it's a grocery business, whether it's apparels, or whether it's someone like Titan, which is jewelry business. So here again, there are no recommendations or anything like that. We're generally discussing company opportunities. And the opportunity is still very huge in these type of businesses. So I 100% agree that the valuations are very high. But if someone is saying that whether it will be a repeat of 250 times from in the next 20 years, I don't know. I don't know about that because but what happens is that for the original holder, 250 times going up 5 times is also from the base, it goes up to 1250 times. But overall, I think this particular area will outperform the market significantly. And when I say significantly, what I mean is at least by 30 to 40%. So if I see market doubling, I see consumption going up at least 2.8 times or 3 times. So that's what I'm looking at.
So are we in that kind of a market where you should expect returns from compounding rather than re-rating? Because EPS into PE is ultimately the market price.
Correct.
EPS for a lot of the good businesses is at a relative high.
Yeah.
Now you're only left with earnings growth. And
Correct.
earnings growth will not be more than 15 to 20%, 25 to 30%.
Yeah.
So are we in for a compounding return now?
So yes, we are into compounding returns, but as I said, I mean, that is the focus. But at the same time, there could be opportunities in this sector as well. Sector in the sense, this theme, which is consumption. So there could be still hidden companies here which can give you phenomenal returns. One has to take efforts and identify them. But the only issue is that you need to have extreme comfort on the management. You need to have extreme comfort on the growth path.
You bought into HDFC Life, I think, 2-3 years ago. And my question that time was that, look, you're buying a business which markets don't like.
Yes.
And the big picture for insurance after that has only become more competitive.
Absolutely.
Changes have happened in the tax structure as well.
Yeah.
Is life insurance in India at a disadvantage now?
So, at least history says that insurance should do well. I 100% agree with you that it has been one of the underperformers in our portfolio. But at the same time, if you meet these companies, they are very comfortable about growth. And I also agree that insurance is extremely underpenetrated in India. So the opportunity is large. But as I said, that whether to bet on insurance through an insurance broker or through an insurance company, the jury is still out. So we'll have to work on it now.
You understand the securities business. You understand the PMS business.
Yeah.
There's a huge AMC business which is now listed.
Yes.
You got UTI, you got HDFC,
Correct.
you got Birla. 3 actually. Yeah. Am I missing on anyone? 3. 3 are the ones which are listed. Those stocks are at a multi-year low.
Yeah.
While the SIP number is strong, these are businesses which are growing without raising capital.
Right.
But markets are punishing these stocks on a daily basis. Is it time to, let's say, look at a AMC stock again?
So let me be frank, I have not looked at a AMC stock as of now. But the reasons why I think the market is punishing them is that it is possible that what happened to broking, say after NSE came in, when the brokerage rates came down by 90%. Maybe market is looking at that, something similar to that could happen in the AMC space. And that is the reason why it looks like that the market is negative on that. But frankly, I have not looked at these stocks.
When it comes to pharma, and before I finish the question or sentence, the automatic reply is US generic.
Yeah.
But now things are looking up within the domestic pharma very,
Yes.
very uniquely. I was looking at data that, unfortunate it may sound, but the influenza and flu numbers were strong in month of Feb and March, and the sales have gone up in double digit.
Yeah.
How should one bet on consumption and a per capita binge in the pharma space?
Okay. So long back, when I say long back, it was in the 90s that I had met Dr. Reddy himself. And I was asking him that what should I look at when I'm looking at a pharma company, in the overall environment. And he had told me that time it's per capita income. The reason being that in India, the per capita income that time was so low that people didn't have enough money for their daily needs. So he said that unless and until daily needs are taken care of, no one is willing to spend on medicine, howsoever essential it may be. Things are changing now. And I think the rise in per capita income will be a key to success in pharmaceuticals. So besides, of course, the other things. So I think pharma is, and I have always believed that pharma is a sector which depends on rising per capita income, and because of rising per capita income, higher consumption. So pharma could be interesting over a longer period of time.
So
Yes.
In fact, since we're talking about pharma